Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Shubhada, founder at QuantEco Research, joining in. Shubhada, good evening and welcome to the show. And always a pleasure
Thank you.
to speak to you and get insights from you. Shubhada, my first question coming to you is that the kind of impact we saw that COVID-19 had on the economy, we went into negative growth. And then slowly, steadily, we have started the recovery journey already. And clearly, the rebound has been impressive. What would you make of this recovery that we've seen so far?
Well, quite clearly, the first half was a washout for the fiscal year at a contraction of, on an average, about close to 16%. And as the gradual unlock phase began for the economy, economic activity showed signs of pickup. Remember, this was also corresponding with the festival season. So there was a question whether this is a festive related demand or a pent up demand of the months gone by. And that is where, most of the analysts were trying to make an assessment whether this recovery is likely to be durable or not. But positively, I think since November, December, post, festive season, the months of January, February also seem to be corroborating to the fact that recovery is getting more durable. Definitely in terms of high frequency indicators that we track all the time, be it through a PMI or industrial production or freight volumes, trade volumes, the whole gamut of indices seem to be suggesting that this recovery is getting durable. Auto sales is one. Rural consumption has remained in a fine nick. Of course, urban consumption could have been better. We have seen incomes stagnating in the urban areas. We have seen fuel impact having some impact on the personal disposable income and so on. So, but overall, as an economy-wide story, clearly the recovery is getting more durable as we see. Now, definitely, since we are not out of the COVID risks and threats, that caveat would always be there that, going forward, it is extremely imperative that the inoculation, picks up momentum for the population, because that would in turn improve the sentiment, improve the, momentum further for economic activity to, get more embedded. So at this juncture, suffice to say that we are looking at a positive turnout for growth in fiscal 22 as everyone else. So we are looking at more or less a double digit 11.5% growth. So which is in consistent kind of a forecasting platform of all the other rating agencies and neutral agencies. We do see that first half could be more of a base effect getting reflected, but organic growth is where we are, more hopeful of, particularly in the sectors which saw a serious impact in the year gone by, that is the fiscal 21, related to the services, where the contact intense sectors belonging to services, be it a hospitality, travel and tourism, and so on, these are likely to get far better in terms of organic growth as we see unlock and inoculation, both, working hand in hand so as to improve the trajectory in terms of growth prospects. Manufacturing has been doing well. If you just trace industrial production, which becomes extremely important to track, what we do see is, encouragingly, the consumer durables and non-durables are looking far better. Pre-COVID output volumes have already been reached. reached. Encouragingly, where I find positive cues for growth going forward is even the intermediate and the capital goods are showing a far better traction. Of course, there would be some concerns in terms of construction and infrastructure goods or primary goods, but barring those, I think a large segment of industrial manufacturing, that is showing a clear improvement. And that is what forms the basis for us to come to an outlook of 11.5% growth in the fiscal 22.
Right. So with this, the budget estimates have also given us some bit of clarity as to how growth would look at. Do you think the budget that was announced is here to provide a booster dose for growth along with an accommodative fiscal stance? Because a fiscal deficit for 22 at 6.8% is slightly higher than what the street was estimating.
Definitely. No, definitely. I think the budget is trying to address not just the near-term growth, momentum, but in our opinion, also the medium term. Introducing some of the very key reform. National sector is one sector that I would highlight, or health, or typically have a couple of years and thereafter as well. So important point was that budget was not just addressing the near-term growth impulses, but trying to ensure through the measures introduced to bring in a long-term durability rather in terms of growth. Yes, it will take us a while to get back to a trajectory which, if COVID had not happened, assessment, unfortunately, India, as elsewhere around the globe, has seen some amount of permanent scarring of growth, as we would call it, or a permanent damage to growth, simply because it's going to take us a long time to play a catch-up to a normal course if COVID had not happened. And that, of course, can get arrested. That delay in catch-up can get arrested if the government and the private sector both work strongly hand in hand to the areas that have been highlighted very rightfully so in the budget. Infrastructure, both hard and soft infrastructure, because there's a larger multiplier, kicker in these areas. So also financial sector reforms needed, because at the end of the day, you need plumbing to, fund that growth. So you'll have a growth gush. But if there is dislocation in the financial sector, it would be only job half done. So it was also imperative to address to the long-term financial needs of infrastructure, whereby the DFI got created. Of course, early days yet, we still await a lot of nitty-gritty detailing of what the government would highlight in terms of the design of the DFI and so on. But having said, I think, the whole focus on infrastructure, health, and finance are the right impulses, which we believe should, take growth somewhere close to about 6.5% organic growth, notwithstanding the double digit that we may see in FY22, but organic growth close to around 6.5% in the coming 2 to 3 years. But of course, a long haul, we need to see what the global scenario plays out, because there are too many moving pieces. While immediate signs are very solid in encouraging the growth getting better, IMF has revised the growth forecasts upward for the coming year. But importantly, does the US fiscal stimulus play out to the tune of 1.9 trillion? What importantly would be the design of both the fiscal accommodation and the monetary accommodation globally as well as in India? Because, if the growth really picks up and inflation risks start building up because of the liquidity gush that is sloshing around in the global system, that would also be the point that a careful balancing act and careful calibration will need to get, carried out by the central banks and by the governments, whereby humongous expansion of balance sheets have happened, both globally and closer home in India, as you rightly said, fiscal deficit at 6.8. It definitely is significantly higher. But even if you remove the transparency that has come on board starting this budget time of the subsidies getting on balance sheet, despite which we do see that fiscal deficit is higher. But at such times, still you see a private sector appetite getting back to a normal level. Government will need to do a fair amount of leadership role as far as kicking the whole economy up in terms of the growth impulses that we are hoping to see in the fiscal 22.
Right. So, Shubhada, all this while the RBI has done enough. The government stimuluses have been good. The budget has been pretty decent now. In fact, everyone's more than happy. How big a risk is a second wave of COVID going to be? Because we have started cases to rise. And and this has come in at a time when we were all projecting things to go on from good, to better, from worst. How big a risk is this? And if we get a second wave, what are the kind of GDP estimates we should be looking at?
Well, and that's a very valid question. And the week or fortnight, as greater lock has happened, has also brought along with it, a ramp up in cases, unfortunately. And that is one risk that we will have to monitor. But on the positive side, if the government does a faster and expeditious manner of inoculation, that could somewhat act as a mitigant to this risk. But for that, government alone may not, be adequate in terms of doubling up the effort. Perhaps government may need to seek out private sector help in ensuring that a larger segment of population is inoculated. But if that risk does play out, incidentally, we do have that risk as a 25% probability in our estimation. If that risk definitely plays out, then 11.5 obviously will get scaled down by another couple of percentage points at least. So we would look at 8.5, and of course it will be constantly monitored, because how much deep into the next fiscal year does that risk linger will also have a bearing on our growth numbers quarter over quarter. But that suffice to say that we do monitor that risk, and we have penciled in a 25% probability of what if there is a second intense wave of COVID. But having said, I think the task, coming close to, the fiscal and monetary stimulus, both have ensured accommodative stance to nurture growth. Reserve Bank of India, while has kept the rates on hold, has ensured that liquidity is going to be significantly adequate to fund that growth that we are anticipating to take shape. I think, as I was alluding to earlier, was also that suppose this second wave does get contained in a very short span, and people are forced to get into the discipline back again, and we see a very short-term risk of COVID second wave. In that case, the whole question would arise: then what does RBI do in terms of liquidity normalization, inflation management? Let's not forget, inflation, while last year was abnormally high at a 6.4, led by supply side disruptions, but and this year we will see a 5%. That's what we are penciling in on an average, but it's still higher than a 4% target that the central bank is working around over the last 4 or 5 years. Now, if we are to look at the risks could emanate from the commodity prices, which have been globally hardening significantly over the last 2 months, particularly the crude oil, the metals, even agriculture commodities, barring gold. Most of the commodities are seeing a significant upside move in prices. Definitely imported inflation will be a risk if growth is continuing and the demand is getting more and more robust. Inflation risk will need to get penciled in by the RBI, would that force RBI's hand to act ahead of its, action that it has designed for the coming year? Probably liquidity management would precede a rate action. And that's why we believe that liquidity will begin to get normalized. Today, if you look at including the government cash balances, we are living with a 8 lakh crore kind of a liquidity surplus. Of course, the CRR, the phasing out of CRR will suck out about 1.5 lakh crores, but that still leaves a fair amount of liquidity. What steps could RBI take? RBI could start normalizing the LAF window, so as to signal that now growth is getting embedded. We need to act gradually towards normalizing a monetary policy kind of a stance. We do believe that if inflation risk, materializes, there could be a possibility of a rate hike, which we had, alluded to as early as in December, that we cannot rule out a rate hike in the last quarter of the fiscal 22, that is the Jan-March of 22. Of course, the assumptions being that, we have the growth playing out as per our expectation of a double digit, that is 11.5% for the entire year. But there are a whole lot of uncertainties. There's a humongous amount of volatility. At least domestically, we are well anchored in terms of the recovery momentum, which all the corporate earning results also do seem to be pointing out that it's not just the bottom line, but even the top line is showing a fair degree of recovery. So yes, we do keep the risks very active on our radar, but even at this point, we are looking at it at around only 25% probability. A larger part is 65% of probability is more towards being able to handle the risks and get the economy momentum back to pre-COVID levels rather quickly.
Right. So with this, do you think the liquidity that the RBI is looking at is something which will support the bond demand as well? Because the gross market borrowing is budgeted around 12 trillion rupees.
Absolutely.
Now, for that as well, we need some bit of incoming of funds to come in from the FI side in the debt market. Do you think that's something which is going to be supportive, taking all the action that they've taken into consideration?
I think yield management is going to get a little bit more challenging for the Reserve Bank of India, as we have recently seen, all of the action that RBI did through OMOs and rejected some of the earlier bids, and then, of course, tried to manage the yields closer to 6%. But what we in recent times are seeing is yields are going back again at about 6.15, 6.20 kind of levels. Now, that is essentially because of two factors. One, very clearly, is the overhang of government paper supply. I mean, as you rightly said, the whole, even if we are looking at a 6.8 deficit, which is lower than last year, a 12.1 trillion borrowing is definitely entailing a large amount of government bonds in the market. And that, along with if economic recovery is taking shape, and if the banking sector, which is the largest subscriber to the government bonds, starts also diversifying its asset book between not just investments, but also towards loans, will have some kind of a peripheral impact on the bond yields also, because the demand to some extent will get corrected. Secondly, the global, in US, the yields have been hardening. If you see, the US yields have now come close to about 1.3 for 1.37 levels. Yeah. Now, that is because globally also, or even in the US, the whole expectation of a sharper recovery because of the anticipated stimulus, sometime likely to get announced in March by the US Congress, as alongside the inoculation program, a wider segment of population getting inoculated, has led to a hope of a quicker recovery in the US, has led to US yields hardening. And what happens to US yields will also percolate down to the Indian bond markets also. Fortunately, I mean, if we look at the post-budget commentary of most of the Ministry of Finance officials, there perhaps could be some work getting done to get Indian bonds included in the global bond indices. If that happens, definitely appetite from FPIs will clearly improve and increase. That could probably help in some kind of a yield management at a much larger kind of a scope. But having said, we are still looking at a 6 quarter as our toppish level for the 10-year benchmark. As I said, there are too many moving pieces. If growth really gets stronger, if inflation, inches up much than anticipated, RBI would force hands to kind of act on monetary policy stance, rate action. So at this juncture, however, we do see that the bias for yields would be more upside than downside. We saw the primary dealers taking a large bit of a chunk, in terms of the market participants' behavior as well as RBI's yield management behavior. So it's going to be a kind of a tug of war. It's not going to be that easy. And why should I just single out RBI? I think globally the central banks have a huge task at hand as to how to gradually balance out nurturing of growth objective and ensuring that macroeconomic stability remains well intact. I think that to me is a bigger challenge for a central bank rather than the treasury or the ministry.
Right. So very lastly, Shubhda, one aspect right now we're looking at is the revenue side of the government as well. Now, taking the fiscal deficit number into consideration, the government is trying to take this opportunity in a crisis, clean up its balance sheet from here on as well, which is a good thing. Now, if you have to look at all the revenue aspects, the tax projections are looking reasonable. However, there is a possibility that FY21 could see an upside surprise. With that, if you see with regards to where the divestment target is concerned, that's not too ambitious. The non-tax revenue is looking reasonable, and they have a heavy reliance on small savings, but maybe reasonable given the rates outlook. So if you have to take the revenue side into consideration, what's your view? Because divestments, usually we have never met them.
Yeah. No, actually, that's absolutely right. The entire expenditure management would hinge around how successful and how quick do we roll out the divestment program. Now, it's extremely critical. As you rightly pointed out, we've had not a very impressive record in meeting the disinvestment targets. But our take is, a whole set of entities that have been identified. A lot of groundwork has already got done in the preceding year. These were the government entities which were identified for divestment, but for some reason, which is unfortunate because we did see equity markets significantly ramp up, and somehow perhaps government missed the bus in diluting its stake. But divestment, if we end up starting very early, right from the first quarter of fiscal 22, will be very, very critical in ensuring that the expenditure that we have penciled out in the budget does not suffer. Because typically, if there is a shortfall in revenue, what suffers is the capex, and that is something that this budget has been seriously working on, is ramp up its capital expenditure. So it's going to be extremely critical and important for the government to roll out the processes, all the background work that is needed for all the entities that have been identified by the government to execution is going to be key. Implementation of all the right sounding measures that have been announced in the budget. Implementation would be very critical in meeting most of the targets. We do agree that on the revenue side, a lot of row items, particularly on tax and non-tax revenue, are quite realistic and achievable. Even the nominal GDP, estimation, in our opinion, it's a tad lower than what perhaps the street would expect at about 15.5%, as compared to what the budget assumes at 14.4 or thereabout. So arithmetic is credible, implementation is key. But if the government indeed succeeds in disinvestment, and what is heartening to note is perhaps the involvement is coming right from the PMO, as if I go by the news bites, that the Prime Minister is meeting the divestment team, to understand the detailing and so on. So if that, execution does take shape, I think probably then we may have a surprise waiting for us in divestment target being met after a long gap.
Absolutely hoping that it falls in place and the economy continues to recover as well. Thank you, Shubhada, so much for joining us on the show. Great insights, and hoping that everything is in place and the second wave is not as severe as what we've already seen so far. Thank you so much. I hope you enjoyed the conversation as well. Thank you and stay safe.